Hey folks, it's Jeremy Whaley here from Trade Maestro, and I want to talk to you today about a strategy that has gained a lot of attention over the last several years, and it is known as the wheel strategy. And so I'm going to give you an overview of the wheel strategy in this video. I actually can't tell you where this strategy came from. I don't know who started it. I don't know who named it, but it is a very good strategy, and it's one that a lot of my students really like, and I'm going to introduce it to you right now. So let's get started with it. This is an option strategy. It's a somewhat introductory type of an option strategy. And what I want you to understand about it is it's really more of a system than it is a strategy. So in the world of trading, a lot of people mix terminology. And this is one of those cases where we're going to take several strategies, several different option plays, and we're going to put them together into a sequence of events that creates a system. And in this case, it's a system for creating income. And this whole system is known as the wheel or the wheel strategy. So I'm going to walk you through it right here. So it's really a system. As I said, it works like this. We're going to sell a naked put or a cash secured put. Doesn't matter if you do it on margin or if it's cash secured. You're going to then buy the underlying stock, and then we're going to sell a covered call, and then wash, rinse, repeat. So let's walk through each of these steps here. We're going to start by selling the naked put. What does that mean? Whenever you sell a put option, the put gives somebody the right to sell the stock at a specific price on or before a specific date. So if you sell somebody else that put, you've sold them the right to sell you the stock. That means you are now obligated to buy the stock. You say, why in the world would I do that? Well, because you're going to get paid to take on that obligation, and you're going to get paid the option premium. That's why we do it, okay? So what we're going to do is we're going to find a stock that you like. That's the key. Well, you don't have to like it. It just makes this so much better if you like the stock. If you think to yourself, I wouldn't mind owning this stock, it makes this strategy so much better. If you're buying it, or if you're doing a naked put on a stock that you're like, I hate this company, I wouldn't want to own it, don't do it. Find a company that you like. Find a company that you're like, hey, I wouldn't mind owning these shares. And then the first thing you're going to do is you're going to sell the naked put against that stock, okay? You don't own it yet. You own nothing. You're just selling the naked put. And the reason we're doing that is to collect the premium up front. Now, you can see here on the screen, more IV, that's implied volatility. The more implied volatility you have, the better. And you generally want to sell either right at the money or slightly out of the money. That's where you're going to get the best premium. That's where you're going to receive the most. And since you want to own the stock, you don't mind selling at the money because you kind of want to put the stock anyway. If you don't want to own the stock, then you're going to want to sell further out of the money. And that's a whole nother conversation. So here's what happens whenever you do this. Number one, you're selling somebody else the right to sell you the stock. We already covered that. You're collecting the premium up front, and you become obligated to buy the stock at that strike price. So it's a standard naked put. That's all that's happening right there. You're just selling somebody else the right to sell you the stock. You're getting paid up front, and you become obligated to buy it. Now, let's talk about the probabilities and why we would do this. Number one, if you're not aware of it, when you do this strategy, you double or better your odds of making money. You literally double your probabilities. If you're not aware, I'll just give it to you. Your basic probabilities, basic market odds of making money if you buy a stock or if you buy a long call option or a long put, your basic market probability is 33%. You have a 33% chance that the stock goes up. You have a 33% chance it stays the same price, 33% chance that it goes down. Well, if you have a long stock and it goes sideways or down, then you're not making money on it, right? With this strategy, you flip that upside down. Your probabilities of making money start at 66%, and it actually goes up to about 85, sometimes 90% or better. It's a really, really high probability trade. That's the great news, okay? Now, here's what happens. Let's say that we sell our naked put. If the stock goes up, you do nothing else. If the stock stays the same price, you do nothing else. You just made money. You literally just printed it out of thin air. If the stock goes down a little bit, but it closes at or above your strike price, you do nothing. Think about how easy that is. You didn't have to buy the stock. You didn't have to time it. You didn't have to sit here and be like, am I in a trend? You didn't have to do anything other than execute a naked put. And you know how easy that is? It's so easy that in a very famous story, Warren Buffett did it in 2 minutes, where he printed $7.5 million in 2 minutes. He did a naked put on Coca-Cola. Made $7.5 million just like that. You could do that too. Now, you may not have the money to cover that. I mean, he has $1 billion to work with, so a few billion, many billion. If you have that kind of cash, go do it. Great. For most of you, you're going to write 1 or 2 option contracts, and you'll bring in $150, $200, maybe $300. Okay. You're not doing $7.5 million at once, but the idea is still the same. You literally just sell to open your put option. And what happens is that money comes into your account and it's there and it is yours to keep. And like I say, if the stock goes up, great, it's yours to keep. If the stock stays the same price, great, it's yours to keep. If the stock goes down but closes above the strike price, great, it's yours to keep. And you do nothing. There's absolutely nothing else you have to do. Now, what happens if the stock closes below the strike price at expiration? If it's expiration day and the stock is at or below the strike price, and the answer is now you're going to buy the stock. You still, however, get to keep the money you made. You still collect the premium and you still get paid for that. It's just that now you have to buy the stock at that strike price. But that was kind of the idea. That's the idea of the wheel. So with the wheel strategy, what we're doing is we're selling the naked put, and then we eventually get put the stock. And when you get put the stock, now we move to step 2. And step 2 looks like this. Now you just own a stock. Your standard run-of-the-mill, I own a stock. I own part of the company. If they pay dividends, I get paid the dividends. We're looking for a capital gain. We want the stock to go up. If the stock goes up, I make money. Stock goes down, I lose money. Linear risk profile. Ownership does not stop until I sell the stock. Your standard run-of-the-mill long stock trade. And by the way, it was automated. It was automated because you sold the naked put, and if you get put the stock, you don't have to buy it. Like, it just, well, you do have to pay for it, but you don't have to execute anything. Like, it just does it automatically. That's how cool it is, right? It's just really simple. So you sell the naked put, you get put the stock, and then if the stock goes up, you make money. If the stock goes down, you lose money. Just standard stock trade. But now, once you own the stock, what can we do with it? Well, if you've seen my video on covered calls, you understand now that you own the stock, you can turn around and sell covered calls. So that's what we're going to do. That's going to be step number 3, is we're going to sell a call option. Now, when we sell a call option, we're doing the opposite of selling a put. When we sell a put, we sell someone the right to sell us a stock. Whenever we sell a call, we're selling somebody the right to buy the stock, which means we are now obligated to sell it to them, which we can do because we own it. In step 2, we bought the stock, remember? So now that you own the stock, you can sell it to somebody. And you say, why would we do that? We would do that so that we can capture time decay. As you get closer and closer to expiration, the option time decay just completely wipes out, and that becomes all your money that you get to keep, that you get to play with, that you get to brag about over Thanksgiving. Now, if you just sell a call, you take on this kind of a risk profile. If the stock goes up, you have unlimited risk. Stock goes down, then you're in the clear. So to make that a non-overly risky profile, what we do is we combine it with the underlying stock, and that's where the covered call comes into play. So when we sell the covered call, we're selling the call on the stock that we bought in step 2. Of course, that limits the upside potential, but it also removes that risk of the unlimited risk of the short call, creating the perfect strategy. Is it really perfect? No, it's not perfect. Look, I'm not going to lie to you. It's not a perfect strategy, but it's a darn good one. Now you say, well, what do I do now? I've sold the covered call. I've collected some premium. What's the next step? The next step is actually to get called away. You want to sell the stock. Okay, so the idea is not to own the stock forever. The idea is to own the stock for a little while, and then we're going to sell it. But instead of just buying it and selling it like you would with a typical swing trade, what we're going to do is we're going to buy it in step 1 using a naked put. So we're going to sell the naked put. We get paid up front. We sell the naked put. Eventually we buy the stock. Then we sell the call. And then we sell the stock whenever we get called away. So we're selling all the time. And if you've ever thought about it, selling is when you make money in the stock market. You make money. Money comes in when you sell something. And that's what we're doing here. Okay, so in step 4, we get called away. We simply sell the stock at the strike price of the call that we sold, and we turn around and we run the wheel again. It's the perfect strategy. Okay, it's not perfect, but it does have some incredible benefits, and let me walk through them with you. Number one, you're guaranteed to make your premium, and that's the reason that we do this. This is the reason that I recommend this strategy. I do this for my parents in their trading account. I have told countless people how to do this strategy and told them to do it. It's a very common question I get. People say, hey, I've got, let's say, $100,000 and I need to create some monthly income. What do you recommend? How can I create monthly income with this? I teach them this strategy. You know, if you have a decent sized trading account, we'll say 20,000 or more. Honestly, you could do it with 10,000. You can do it with 5. But, 10, 15, 20,000, that's a great size trading account to do this with. And if you've got that size of a trading account and you want to create weekly or monthly income, this is a perfect strategy for you. Okay. And it's a guarantee that you're going to get that premium. Now, you may end up with some stock, and some of that stock may go down over time, but you're still going to get that premium, and you're going to lower your cost basis with it. So it's a great strategy for that. So you're guaranteed to make your premium. It's a predictable way to create income. That's the big one right there. Create income. You're going to use it to lower your cost basis. It's going to help you maximize your returns. It also creates a more forced discipline for your entries and exits. And I want to talk about this for a minute. I deal with this with traders all the time, where they buy a stock, but they're afraid to sell it, or they're afraid to buy it, or whatever. There's always fear, right? Everybody's so afraid of everything. Well, when you sell the naked put, I'm going to get put the stock at this price. There's your entry. And if you sell the call and you get called out, that's where I'm going to sell it. So there's your exit. It's defined for you. It really forces discipline. It forces the exact entries and the exact exits. Okay. But you get paid to do that. So it's great. And then, of course, you can always close it early if you decide, hey, I really don't want to do whatever this obligation is. You can always buy to close it early. So it is a great strategy. It's a very, very flexible strategy. You can actually, use this strategy, get into a trade that maybe goes against you, but because you're selling calls against it, you can actually keep lowering your cost basis and eventually turn that into a winner. You can do adjustments on these trades really forever, and you can just keep trading it and keep printing money with it. And it's a great strategy. It is a great strategy. Is it perfect for everybody? No, I'd be lying if I said it was perfect for everybody, because it's not. There's some people that are wired for day trading. There's some people that are wired for, different strategies, but this is a really, really good one. And if something that you think you might be interested in, well, I have great news. I have a brand new training program on this. It's called the Retirement Wheel, hence the name, the wheel, right? But this is exactly what I'm going to teach in this program. It's an accelerator course, which means we're going through all the content really fast so you can really get up to speed on it. And what I'm going to do is I'm going to teach you how to sell the naked puts, exactly what strike prices to sell, how to collect the premiums, and then buy the stock, write it up, and then sell it with a covered call, and turn around, wash, rinse, repeat, do it over and over again so that you can start collecting those premiums and creating your consistent income. Now, if that sounds interesting to you, you know what to do. Check me out over at trademaestro.com. I'll put the link below. I'll put it in the comments. And if you haven't liked and subscribed to the channel yet, then this is a really good time to do it. I mean, I don't know why you wouldn't have, but let's just assume that maybe you haven't subscribed yet. Go ahead and do that so you get all the notifications and you get the awareness whenever we're sending out new videos, when we go live, and all that great stuff. Thanks again for watching. Hope you've got something great out of it. Let me know in the comments if you got any questions. And until next time, I wish you the best. Happy trading. We'll talk to you soon.